Welcome to your one-stop home buying guide. Whether you're looking to purchase your first primary residence or you're purchasing your 10th investment property, this video will lay out the home buying process from start to finish and will be a great resource for when you have questions down the road. If I haven't met you yet, my name is Connor Webb. I'm a mortgage loan originator licensed in Washington, Oregon, California, Idaho, and Arizona. I've been doing this for a decade now, and I've helped tons of home buyers, like I mentioned, first-time home buyers, move-up buyers, investors. I'm here as a resource. If you have any questions or are looking to map out your next move, you can visit lenderconnorwebb.com to reach out and get in touch. Now let's get into step number one, which of course is planning your finances. So before you do anything, I would just take a moment and think about where you're at with your finances. And by that, I mean thinking through how much in funds you have available both upfront as well as on a monthly basis for your upcoming purchase. We'll get into the details of what to expect both on a monthly basis and upfront for your purchase, but the typical closing timeline is going to be a 30-day close. So thinking out, okay, when do you want to move into your property? I would recommend getting pre-approved, starting that process 60, 90 days out from that date, and then go into it knowing that your actual purchase, once you get under contract, is going to take around 30 days. And as we go through this, just keep in mind that I'm not a financial planner, so make sure to consult with your own financial advisor. If you have one, consult with your CPA. If you have tax questions, I'm happy to answer questions on certain topics, but then I can direct you to certain individuals if we need to. And at the end of the day, only you can decide what is within your budget, what you feel comfortable with paying on a monthly basis. I can help you figure out what you qualify for, but then deciding what is within your budget is a whole nother question. So the first question to ask yourself as we move into this process is how much per month do you want to spend on your housing payment? There's a slogan we use in mortgage, which is PITI, which stands for your principal and interest, your taxes, your insurance, and then also there's a plus for if there's an HOA added on top. The principal and interest is how much goes into paying down the principal of your mortgage balance. The interest is going towards, of course, the interest on the mortgage itself. The taxes are the property taxes that are due on a monthly basis. Then there's going to be two parts to insurance. One is the homeowner's insurance, and then two is mortgage insurance if you're putting less than 20% down on a mortgage. So before you get searching for homes, figure out what on a monthly basis is your max monthly payment that you're not wanting to exceed with all of these items included. On top of the monthly payment that you'll be making every month with your mortgage, there's going to be an upfront cost associated with buying a home. Now, a common misconception that people have is that the only thing you have to come in with at closing is your down payment, which, for example, if you're a first-time home buyer on a conventional loan, would be a 3% down payment, 3% of the sales price. With an FHA loan, the minimum down payment is 3.5%. With the VA loan, you can come in with as low as 0% down, and same thing with USDA. Now, keep in mind that all of these down payment amounts are specific to single unit primary residences. If you're looking to buy a multifamily property or if you're looking to buy an investment property, a second home, the down payment requirements will vary. Now, this next slide will apply to you if you're looking to sell a property in order to purchase another one. So if you're selling a home, what will you net from the sale of your current residence? Your net profit is going to equal your sales price minus your mortgage payoff, minus the realtor fees, and minus any other expenses you might have. That net profit is oftentimes what people will roll into their next property. And if you're looking at an investment property and you're rolling the net proceeds from the sale of one property into another investment property, you might want to look into a 1031 exchange, which gets into a tax piece. And if that's the case, I can connect you with a 1031 tax advisor. But that leads into the next slide, which is figuring out why you were looking to buy a home. Are you wanting to build an investment portfolio long-term? Are you looking to just have the American dream of home ownership? Or are you looking to potentially downsize as you head into retirement? All of these different situations will change how you approach these different factors. As you get further into the process and start looking for properties, make sure to stick to your why. Why are you looking to purchase a property? Try not to let your emotions get to you, as hard as that might be. Now moving on to step number 2, which is finding a lender. This is where I can come into play. I can assist with your pre-approval up front with help guiding you with your finances. And my role in general is to figure out if you can get a loan in general, and then how much would you be pre-approved for. This is step number 1 before you start talking to a realtor, before you start looking at properties on Zillow. Make sure you figure out what is going to be within your budget. As a part of this, we'll be looking at mortgage interest rates, and this is a chart of the 30-year fixed mortgage average in the United States over the long term. This is dating back to like 1970. The peak was in the early 1980s up here, over 18% for the average mortgage interest rate. And then as of right now, we're hovering somewhere around 6.25 to 6.5, depending on the day, depending on your loan scenario. And you might be comparing your situation to when some of your friends bought back in the early 2020s, when mortgage rates were in the 2%, the 3%. We will not see mortgage rates get back to that point. This really is the new norm, and I think we might see interest rates trend downwards into the mid-5s by the end of 2026, although I don't think we'll go much lower than that. As you can see here, from the housing crisis back in 2008 up through 2020, the average mortgage rate was somewhere around 4 to 5%, but a part of the conversation we'll have is where interest rates might be for your current situation and how we might be able to improve that. So once you find your lender or reach out to myself at leonardconnorwebb.com, we're going to be looking at getting you pre-approved. So during this process, we'll look at which loan types you'll qualify for, what your max purchase price might be, what interest rates you'll be looking at, your ideal down payment amount, depending on your situation. We'll go through the estimated costs of the overall purchase process, and your realtor might require you to be pre-approved in order to view homes whatsoever. Some listing agents that are selling properties will ask for a pre-approval letter up front before they allow a buyer to look at their home. So in general, it's a good thing to get pre-approved, but sometimes it's required to get pre-approved. During the process of communicating with your lender to start your pre-approval, you're going to be looking to gather up the documents that we'll be needing to verify your situation. If you are a standard W-2 employee who is making a salary or an hourly wage, we're going to be asking for your most recent 30 days pay stubs. We're going to ask for your most recent 2 years W-2s. If you're self-employed, that would be 1099s. And if you're self-employed, again, it would be your 2 years of tax returns so that we can average out your income on a yearly basis. We're going to be asking for 2 months of bank statements no matter your situation so that we can verify where the down payment and the closing costs are going to be coming from. We'll need a copy of your driver's license. And then if you currently own a home, we'll ask for your most recent mortgage statement. So these are the general documents that you could just put into a Google Doc folder so that whenever you're looking to get pre-approved, you have it ready to go. You can share this with your mortgage lender and make the process that much more seamless. So the steps of the pre-approval are going to be: 1, getting an application completed, which should just take 30 minutes on an online application. We'll go through a credit pull to check out your credit situation, where your credit score is at, what minimum debt payments you might have, and other liabilities. At that point, we'll also gather those documents that you just put into that Google Drive folder, and then I'll be able to assist in giving you a pre-approval estimate of what you might be approved for on your max range. Then once you're officially pre-approved, I will communicate that with you, but I typically don't send a pre-approval letter, a blank pre-approval letter to anybody, because I custom make the pre-approval letter specific to the offer that you're looking to make, and I send that to your realtor when you're offering on a property. If you qualify for a $750,000 purchase price, I don't want to send a generic $750,000 pre-approval letter if you're looking to offer on a property that's $650,000. You don't want to give the seller or the listing agent more firepower than they need, knowing that you qualify for more. Once you're pre-approved and we've looked through your financial situation, here are some do nots. Do not make any major purchases, especially adding debts. This can, of course, affect your debt to income ratio if you're incurring a new debt. You can buy the new house or you can buy the new car. You certainly can't do both, especially after we've already pre-approved you. And if you haven't communicated to me that you're going to be making that purchase, so I can verify that you would still qualify. Certainly do not change or quit your job. Your income is one of the most important pieces of qualifying, and if anything changes with your income for worse specifically, then that could certainly take you out of qualifying. Also, if your pay structure is changing, like if you're going from a W-2 employee and you're becoming self-employed, do not do that unless you consult with your lender, because that is a certain deal killer. I would recommend not moving large amounts of money around between bank accounts, because any deposit that we see on your bank statement, once you get under contract that is above a certain percentage of the sales price, will be flagged as a large deposit, and we'll have to source where that comes from. You are allowed to get gift funds from family members throughout the purchase, but we would recommend you do it a different way than having them send it directly to your bank account. What I'm getting at here is, before you do anything with your financial situation after you've been pre-approved when you're looking to buy a home, make sure to consult with your lender. You might not even want to pay off debts or collections once you've been pre-approved, although you might think that that will help your situation. If you're looking to come in with a minimum down payment and you're paying off a debt that now takes you out of qualifying because you don't have that down payment anymore, then that obviously would change things. And certainly make all of your minimum debt payments on time. Do not allow any late payments to be incurred. One 30-day late charge on your credit report could drop your credit score by 30 to 100 points. Once you are pre-approved, now it's time to reach out to an agent and get shopping for homes. Here's a few do's when you're looking to shop. You'll get updates from your realtor search as more homes become available and fit within your criteria, so make sure to be on the lookout for all of those updates. When you're out on your search, make sure to stick to your lender's max price point that you're pre-approved for, and specifically your monthly budget price point that you weren't wanting to exceed with everything included. When I talked earlier about not letting emotions get into things, this is where it comes into play. You're going to want to push your range. I would highly recommend to not look at homes that are outside of your price point, and your realtor won't even show you properties that are above your budget, because essentially it's just wasting your time and theirs. Make sure to go back to your why to set a timeline and also your sense of urgency. Part of this will be making a needs list versus a wants list. There are certain things in a property that you absolutely need, and then there are certain things that you might want. If a house has everything that you need and fits within your price point, then you might want to pull the trigger sooner than later before it comes off the market. If it has a few of your wants as well, then that's just a cherry on top. And when you're out shopping, getting back to emotions once again, don't get emotionally attached to a property, because like I briefly described just a moment ago, properties come and they go, and if you don't act quickly on a property, it very well might be gone the next weekend. Don't move too fast or too slow to schedule a showing. You don't want to schedule a showing on every single property that pops up. You don't want to schedule it immediately, but you also don't want to move too slowly. So reach out to your realtor if there is a property you might be interested in, and you could see if it makes sense to actually schedule a showing. And like I just mentioned, don't feel like you need to see every single home. Some homes you could just look at online and kind of get a feel for what you like, what you don't like. But once you do find that home that you're looking to make a move on, that's when it's on to the next step, which is actually writing your offer. When you're looking to write an offer, you'll have a conversation with your realtor, you'll have a conversation with myself, and there's multiple variables to an offer that you're going to be wanting to look at. You're going to consider which sales price you might be offering at. You're going to consider which closing timeline might make the most sense if you want to be competitive on an offer and have a short timeline that could win you a deal. You'll also want to consider if you're going to be having any seller credits or seller concessions, which would help reduce your out-of-pocket expense in your overall closing costs. For example, let's say a property is listed at $500,000 and the seller is needing to be at that price point to net the amount of money that they're looking for. Well, you could either go with an offer at the full asking price and just go $500,000 and you're going to pay for the closing costs yourself, or you could offer $510,000 with a $10,000 seller concession. And essentially what this means is that you would be buying the property for $510,000. The seller would give you a credit of $10,000 at closing. And this $10,000 would go towards paying your overall closing costs and prepaids at closing to reduce your out-of-pocket. If you have any questions on this, feel free to reach out and I'd be happy to clarify. Now, once you submit an offer, the seller can either accept or counter your offer. They could also deny it straight up, but most likely they're going to counter. If your offer is accepted, then the contract will become a map of the overall transaction, laying out the timeline, the sales price, and exactly all the details of what to expect. A few tips when you're looking to make an offer is to write an offer that helps you win. What does the seller need out of the offer? And like I mentioned, if the seller is needing a shorter timeline and they're needing to get out of the house, then you can write an aggressive timeline and that might win you the deal. But as with everything else, make sure to ask your agent how to make your offer more competitive. You could also have a conversation with your lender to see if there's anything they can do to help you as well. And then make sure to ask your lender to call the listing agent to vouch for your qualifying when the offer is submitted. It's often the case that I'll reach out to the listing agent, or the listing agent will often call the lender just to walk through their situation and feel out how clean their pre-approval is and how likely they're going to close on time. So once your offer is accepted, you then become under contract. Congratulations, it's now on to the next step, which is going to be your home inspection. Your home inspection is for your own good. You're going to use a certified home inspector to examine the home, see if there's any big red flags coming up on the property that might need to be taken care of before you close on your purchase. From that inspection, you'll get an inspection report that your inspector will go through with yourself and your agent to see if there's any real big flags or if there's just smaller items to maybe keep an eye on. The contract that you negotiated with the seller is going to determine if and when you can negotiate repairs to be fixed by the seller. There's typically a inspection contingency. So if there are big red flags that come up during the process of the home inspection, you can back out at any time and you'll get your full earnest money refunded. But you might have waived your inspection contingency like it was common during COVID when interest rates were low. There was a ton of buyers in the market, multiple offers on the table, a bidding war. People were waiving their inspections so that even if an inspection came back bad, they couldn't back out of the deal without losing their earnest money, their skin in the game, which I highly do not recommend. But again, consult with your agent, get their advice on what you see from the inspection report, and then move on accordingly. This is a big moment in the process. Like I mentioned, you could back out of the deal if there's big red flags, or if you're going to be proceeding, then you're going to be moving past that inspection contingency. That's when you know things are getting serious. But you can request repairs, you can request a concession instead of a repair to be taken care of, or you could renegotiate terms in general. If the seller is motivated, then they're likely going to want to find a middle ground. At this point in the process as well, you'll also be shopping for your homeowner's insurance. Your homeowner's insurance is to be there in case anything were to happen to the property. For example, a fire, flooding, natural disaster, etc. Up in Washington, there's various flood zones. If you're in California, there's going to be fire hazard zones and you might need additional insurance. But this is something that you get to shop for. And if you need a connection to an insurance broker that can shop between multiple carriers for you to see if you can get a more competitive rate, I'd be happy to connect you to someone. And like I mentioned early on in the PITI, the monthly cost of the homeowner's insurance is included in your monthly payment. And part of the prepaids that is due at closing is going to be a full year of homeowner's insurance paid up front. A portion of your monthly payment moving forward beyond closing will be your homeowner's insurance as well, and that will be put into your escrow account so that when your homeowner's insurance becomes due that next year, that it will be paid directly from your escrow account. Now moving to the next step, which is the underwriting process. So I myself am not the determining person to determine whether or not you qualify for a loan or whether or not your loan will close. The underwriter is the decision maker in the process, and they essentially want to make sure that you have the ability to repay the debt that you're about to incur, and also that this loan follows all of the loan guidelines for whichever loan program you're going with. Your loan originator will update you whenever they hear back from underwriting and if there's additional items needed. In most cases, it's going to be a conditional approval at first, which means that your loan is approved, but we need additional items. One of those items that we are going to be needing is your home appraisal. Your appraisal is for the lender, but the borrower or the buyer of the property will actually own the report. They pay for it out of pocket and they get a copy of the appraisal themselves. But the appraisal is to verify that the value of the property is at a certain point to where it meets all of the loan guidelines based on the down payment requirement that you're bringing in. Ideally, the appraised value will be at or above the purchase price. If your appraised value comes back above the purchase price, then that's great. You walk into some instant equity. And the lender uses the lesser of the purchase price or the appraised value as the effective value for your loan financing terms. We'll get into more of that in just a second, but the appraisal inspection is scheduled and then the report will be sent to you once that is completed. So here's scenario one for an appraisal coming back. Let's say you get under contract on a purchase price of $500,000. The appraised value is $520,000. So the effective value for your loan financing terms is the lower of the two, which is going to be $500,000. This is the value that the loan amount and the down payment amount is based off of, and this essentially means that you're going to be walking into $20,000 of instant equity. The flip side of this is if the appraised value comes in below the sales price. Same scenario, you buy a property for $500,000, but in this case, the appraised value is $475,000. The effective value is the lower of the two, so it's based off of $475,000. Really, the two options here are to lower the overall sales price to $475,000 so that you can still bring in, for example, 3% on a conventional loan of $475,000, or you can bring in the difference between the $475,000 and the $500,000 as an additional down payment. Same as earlier as well, the seller, if they're motivated, are going to want to find a middle ground, so they might be willing to negotiate on this. Once the appraisal is back and we're all in good shape, then we move on to the final step, which is going to be closing. Once we gathered the additional documents needed, as well as the appraisal, we submit it back to underwriting, then we get your clear to close. There's a lot that takes place in the final days leading up to closing, especially that final week. You're going to go through your final walkthrough about 24 hours before to check that the property is still in the shape that you expected. You're going to be reviewing your closing disclosure, which is going to be a much more accurate representation of the numbers of what to expect to come in with that closing. And once we get your clear to close from underwriting, that's when we'll be able to see if there's a potential to close early. Our goal is always to have the ability for our clients to close early, but it doesn't always happen that way. Once the numbers are all lined up and good to go, that's when you'll get your closing signings set up with your escrow or title company. That is the third party that is handling the exchange of funds between the seller and the buyer. That's where you'll go to sign your final papers. You'll get a copy of all of your closing documents, and then you'll also get the wiring instructions from escrow. And the wiring instructions describe the exact number that is needed for the remaining cash to close. You can just drop off the wiring instructions at your bank. They'll be able to wire the funds from your account directly to escrow so that you're all set to go for closing. I would recommend wiring your funds instead of writing a check, because a check might take a day or two to actually cash, but a wire should be relatively instant, so we could do a same day sign and fund if you're wiring your funds. After that, it's a matter of figuring out when you're going to be receiving your keys and your occupancy to the property. Once you sign your papers, once the loan funds, then the transaction has to record with the county until you become the official owner of the property. There's typically a cutoff time of 3-4 o'clock in the afternoon for the county. So if it's later on in the day, you might not record until the following day. But then looking at the first mortgage payment and beyond, the first mortgage payment that you will be making is usually due in over 30 days after closing. As I've been describing, there's your down payment, your closing costs, and then your prepays. Let's say you close on your property December 15th. You're going to prepay from December 15th through December 30th at closing, your first essential mortgage payment. Then all of January is going to be taking the time to build up your first official mortgage payment. So you close December 15th, you're going to be prepaying through December 30th, and then your first mortgage payment actually won't be due until February 1st. So you close December 15th, you prepay at closing through December 30th. That January is going to be building up your first mortgage payment, and then your first mortgage payment officially becomes due on February 1st. And in most cases, your mortgage isn't officially late until 15 days after the due date, at which point there is a late fee that's assessed, and it doesn't officially affect your credit unless it's 30 days late. Moving beyond that, your principal and interest payment will not be changing for the full term of the loan. If you're a 30-year fixed mortgage, your principal and interest payment will not be changing for the entire 30 years unless you were to refinance or pay off that loan. You will want to pay attention to your escrow account, which is your taxes and insurance that is being collected. As every year, your county will reassess the value of your property taxes will change, likely since property values keep going up. Your property tax amount will increase on an annual basis, so don't be shocked if your mortgage payment increases over time. But that's because your property taxes are increasing, and then also your homeowner's insurance very well might increase as well. So there you have it. That covers the home buying process from start to finish, from pre-approval to moving into your first home or your 10th home potentially. If you have any questions, feel free to reach out. You can visit lenderconnorweb.com to reach out and connect. And for more mortgage and real estate content like this, make sure to subscribe to my YouTube channel. You can find me across social medias, and I'll see you in the next one.